It's great to be start our sustainable finance talk, TiiQu Talk today. So I'm going to share my presentation first. Okay, so I'm going to slide show. Okay, so I assume that you can see my slide.
Yeah.
Okay, so I'm going to start. Today's talk will be the very broad topic that I prepared to cover as many topics that possible to relate to the sustainable finance, but probably time maybe allow, we can try to cover as many as possible. So yeah, I was so ambitious because I look at the sustainable finance and then what will be the relevant topic to deal with because it's so broad. So I have my preferences because I have some narrow scope, some expertise that I worked on. So for example, that the general question like a current status of sustainable finance, yeah, that's one that we can approach easily. And then financial resilience of the ESG-minded companies. Yeah, it's kind of like is for the financing or the investing. It is the like invest side. So actually this is a fundamental goal because why we invest in ESG-minded companies, because driving their like the business practice to be ESG in mind. So that's the purpose. So actually we want something that we invest to ESG fund to this kind of the portfolio company, and whether they can be improved their like resiliencies. And then also, this is one thing that also the Laura's question, like a trade-off, right? A trade-off means that the trade-off between what? Usually in the investment means that the usually not trade-off for traditional investment is for the profit, right? Return. Financial return is the first goal. But the difference between the traditional investment and sustainable is investment finance is that we have another the value we want to try, we want to have. That's the sustainable value, environmental, social, any kind of. So, so in that case, that we want to pursue several values, especially the traditional financial return and other like a sustainable value, and then usually that we can think of a trade-off means that even we not have a like maximize the financial return, but we are trying to do have a like the values for the financial return also at the same time for the sustainable values. So that's a trade-off. So we will look at the what is the issue with the trade-off, and especially for the like investors, usually what they think about is a financial alpha, like it's like a risk adjusted return with above the like normal of their market value. So this is the every like investors are looking at it, and then whether we can have this kind of thing in the like even in the sustainable finance area. So that'll be the hard issue and a lot of debate also. And then also we are interested in whether this kind of effort, the financial like sustainable financing can drive like low carbon economic, because of the climate change risk is severe, more and more severe, and we global effort to reduce the carbon emission. So whether they can be contribute, and also like how actually to measure the performance, right? Because to the investors and investees, how we measure it. And then there are a lot of the like issues also. For example, there are too many like measurement metrics and the standard to measure, and also like for example, based on this measurement, how you measure the KPI and how you report it. And you know that recently there was some effort to make them standard of this kind of unified scheme of the reporting of something like that. And then also a lot of the investors like complain about what is the like standard way to evaluate their like financial performance of their investees or something like this. So that's one we need to think about it. And then also we have a, for example, our another speaker is Ernesto is also the expertise in the some technology like blockchain or something like that, and then we want to see some transparency about this kind of measurement data, and also like for example that how we get like investing grade like a measurement, something like that. That's another topic that we can think about. And also we are thinking about, this is the one maybe uh, not for the investors, but investor side, because this is also important because, for example, BlackRock CEO Larry Frank recently that announced that like he still the hope for the stakeholder capitalism. So that's why he preferred to invest in ESG. And then you know that in the United States, 1/3 of the like asset under management into this ESG and this sustainable finance investment. And then there are still debate, a lot of debate. Maybe this is one topic actually that I did several times of my own webinar with the expert of in this field about whether this stakeholder capitalism is still working, especially for the one of the techniques in the sustainable financing or the ESG investing is active ownership. So that you invest and also you have something participate actively in the control of your portfolio companies. And then there was some interruption and there was some debate. So if I have time, maybe I will explain further later. Okay, so we have actually initially we supposed to have three great speakers, and then actually unfortunately, you know that because I did and then I work with Laura and also personally or in many times of the webinar and then this kind of the discussion. I try to announce that today's speaker is conflict like inclusion and diversity. Because you see that
you are absolutely Alex.
Yeah,
it's right.
you
We
see
had
that, right?
finally
Ethnically,
two speakers.
yeah, sexually, regionally, we are conflict like inclusion, diversity, and equity, right? Because but unfortunately, the Siliana is he has a family emergencies today. So he need to take care of that matters. So unfortunately, he could not join. It's unfortunate, but as a friend, I like this one. You know, like, because this is very very important because why are we doing this one? Because we also want to be even in our like meeting, we want to be like follow the like ESG sustainability like philosophy, right? So Laura and me try to invite as possible as try to fill this kind of thing, and finally we have it right today, right?
Well, yeah, so for once that we had two female speakers and one male speaker, plus you as a moderator.
Well, I mean, different nationality, sex, and ethnically.
Anyway, we will try more hard next time. No worries.
Yeah, next time, yeah, probably, yes. Okay, so we only have two distinct speaker today. So I will set the stage, and then because I need to fill some gap, so I prepared some presentation to provide a general overview, and then followed by the Joyce and Ernesto will talk about their insight about the sustainable finance and individually. And then we will get together as a panel, and then I will moderate this panel discussion later. Okay, so fundamental sustainable finance 101, right? Because I just looking at the definition, for example, European Commission has provided very detailed sustainable financial refer to the process of taking ESG considerations into the account when making investment decision in financial sector, leading to more long-term investment in sustainable economic activities and projects. And in shortly, is the ISSB, or is one of the guys now working for the one unified reporting standard. So sustainable finance refer the process incorporating ESG factors into financial decision making, right? And then in the economic side, Harvard University, like sustainable finance define the investment decision to take into account ESG factors of economic activity of project. So this actually this definition includes what I talk about in agenda, right? So in big investment, ESG factors and considerations and financial decision making, and in the sub topics actually that I mentioned and listed in the agenda will be putting in here. So we are looking at these three aspects first. Okay, so what's the status? So for example, Sustainify is a good like statistics about the, and then I just pick up something the relevance for our topics. So the like a sustainable finance fund, right, is a money. We need money to invest. So it's reached 2.7 trillion in last year. So huge amount looks like. And then also like today's like title, 70% of investors believe that sustainable investing implies a financial trade-off, right? So we are looking at this trade. What is meant by trade-off, and is there any better way? This one actually my expertise, and I have a very interesting in this topic, whether trade-off balancing. So I'm trying to develop several kind of like a framework to rather than trade-off but balancing, and I did several webinar about this topic before, so we can talk about more. And then for the like regional, you see the Europe lead this area. So huge difference. So US, the mostly I'm sitting in the US, and then I originally from South Korea, and I once I grew up, actually I have lived in US around 30 years. So half of my life in US, but I don't think about both. Everything was reading by US, but whenever it comes to the sustainability ESG, the situation was not like as the most of us like financing or management and regulation all are read by Europe. So the US is floating, but the situation will be changing more and more. And then also we need to think about like, for example, this is one actually that we did in the previous like a TiiQu Talk. We talk about sustainable infrastructure, but we should think about sustainable infrastructure is very critical point, critical like essential part of this sustainable financing, because most of this one will relate like for UN SDG like goals, and also like for example climate change risk management, something like that. And then you will see that there are a lot of the green bond markets. So this is a fixed income base, like a fixed like a based the investment. And then green bond means that for example that you are the, for example, you are the company of like in the heavily generating like a carbon emission, like from electric utility company. And then if you want to like to like invest for your like a sustainable ESG practice, and then you can issue your bond, green bond, right? This is kind of like some debt financing, because in return, actually, you promise that you in a certain time you will pay off, so payback. So this is a green bond market, but only the 1% of the green bond market invest in the green bonds, right? It's a huge bond, right? For example, US bond or the government bond or something. The big companies have bond, but only 1% utilizing for the like green bond market. And also particularly for the, it looks like that this kind of like global social fund is at least 2.7 trillion. But the reality is the infrastructure for the developing this kind of sustainable infrastructure requires $6.3 trillion, right? So we have a lot of gap to actually need to be invested and available fund to invest. So this is the one we need to think about it. Okay, so this is actually that I haven't covered today's missing speaker, because she actually is from the Green FinTech Forum. So it looks like is a is a private sector like association. So I'm look at the particular important thing is that what are they trying to do? So their goal like a challenging opportunity climate change. So the green financing, for example, is so green means that the among the topic of the like sustainable financing, they are focused on environmental issues, and then for the like for example, they are interested in the climate change, ESG factors, and there also like green funding options, and then impact of the crypto. It was very interesting because they talk about also blockchain cryptocurrencies. So I actually including one topic in my presentation to if you in case that you are not familiar with this kind of technology stuff, and also carbon like there are many kind of the carbon like accounting stuff, and then also like was also very interesting. Central bank digital currencies, they call CBDC, and then this is very specific topic that I'm going to have my webinar about this topic 2 weeks later. But yeah, it was also they also looking at some in green financing with the CBDC, and then lot of regulator. Yeah, regulator is very greenwashing, and then also talk about why they choose greenwashing, something like that. Okay, this is one actually that I put this slide this morning because I hesitate to introduce something related some in the deeper level of the technology or something like that, but maybe valuable, for example, because of that initiative. So green fund means that like investment fund for clean transportation system. So this is one thing. Transportation is like a sustainable infrastructure, like electric vehicle or the green building. Like for example, that the buildings in the smart cities or the cities in the urban area will be generate a lot of the like carbon emission, and then renewable energy system is very important. For example, in sustainability, that we have like in RE 100 like initial like renewable energy 100% initiatives. All of the like companies are now adopting this point. So renewable energy is very important. And waste management, yes, we are very like in relation to like the circular economy. So we are want to like recycling waste or the like reserve our like water and something like that, and also like a greenhouse gas emission, air quality improvement. So all the like related like environmental issues that they want to invest their money to improve the situation. And then the way actually they're doing this kind of green fund is many different ways. Here is one recent effort in this is called like the in the fintech guys. For example, I'm pretty much familiar with this to talk with this kind of with the related expertise in, for example, Wall Street is close my Boston area. So for example, that they try to find new ways to like fund through this kind of utilizing the new technology. So we call metaverse. Metaverse is one way to actually implementing your like experience through the immersive way to the digital space. And then NFT is the representation of the your asset value. And DeFi is a financing system through the decentralization. So we call blockchain based like a financing system. So this is a kind of, you can think of a Bitcoin like the on like no the government body, the governing body will be control this system. It will be autonomous. And then there are many ways actually you developing the financing system. And then this is one thing that I developed was that you can tokenize your asset. The asset means that your target like a solar in the plant, wind farm, carbon credit, whatever relate to like a green financing target. And then also like green infrastructure, and the issue your token. So token means that it is the like representation that the value of this your asset. And then you can use these tokens to like a financing. So one example, maybe the crowdfunding is one way, right? Because the people can finance. So they put their money, and then they will receive these kind of tokens. And then this company will, the hosting company, usually the special vehicle, will be utilizing this kind of invest money to increase more fund and invest their money to the like a target like investors, something like that. So this is a new trend that in the technology, the blockchain, like metaverse, NFT, DeFi, they are looking into the like new ways to like the financing, the sustainable financing area. And this is one actually that I share my like a presentation with you. So just look at it. It was fun because I tried to understand all aspect of the ESG investing. So I went, I saw this publication is coming out, and then I just summarized everything here to actually to make me understand better. So you can look at it, summarize every aspect that I talk about today. Okay, so also I'd like to mention about the sustainable financing regulations. So yeah, you see that there are a lot of the regulations related to, like, for example, the management of the sustainable like practice, or some of the like regulation, like environmental issue like that. But there are not many, in particularly for this kind of the sustainable financing area. So one, yeah, very particularly the important thing is SFDR, the EU Sustainable Finance Disclosure Regulation, is to make a transparency about your investment. So to protect to like the investors. Investor in here means that usually you are in this in the field, and you understand that the fund will be like consist of the like a general like managers and the limited partners, right? So the limited partners actually they are the owner of the investment. So they want to protect the owners of this investment, like for example, you can think of like endowment, like university endowment, the government like operate the fund, or some other type of the investment, like a fund will be they want to like also like some of the other type of the like for example, some kind of the investors that they want to protect. So they make a series of rules that actually protect their investors, to make the transparency of the how actually they invested, and what is the performance outcomes, or something like that. And then not now, but U.S. regulators, especially the like SEC, so security exchange agencies usually they have a concern about this one. So they're looking at some guidance for the financial firms. And then also recently there were some greenwashing. We mentioned about the greenwashing. So they're boasting something, and then they just make this as a put green in front of with green ETF, like green board or something, green fund. So they put in like green in front of their like a financial product service or something like that, but actually was not. So there was something effort to like looking at whether they are actually this title as a green is actually true. So they are to try to looking at the scrutiny about the greenwashing. And then ESG factor we should understand. So I'm not going to talk about much because I assume that you are the already the expertise. So just to summarize, just think that. And then I mentioned that the for example, like we are the gender diversity, inclusion, like equal opportunity, everything is social, like. And then also we need to think about the what kind of issues, like what is the risk with this. Usually in the investors and investing companies looking at this kind of the ES factors as a risk factor, also opportunity factors. So they're looking at it and how you can measure it and how can they manage it. So I just provide all the information, so maybe have you. Okay, so this is the critical point in the, yeah, whether we are looking at the trade-off or balancing. So I already mentioned that I'm really interested in not just trade-off, but the balancing. So I already explained that trader means that we think about like the return by the financial return and the sustainable value creation, right? So I mentioned that usually that this kind of like a sustainable value creation is longer term than the like a shorter term like a financial return. So some way actually we need a trade-off. So here is we have to consider that what is the difference between the ESG investing and impact investing. So in the impact investing, we maybe not consider too much on the trade-off, because impact investing has a specific goal to impact something. And then in this impact something is to ESG sustainability, then there's a sustainability impact investing. In that case, they more weigh on the outcomes of the return by the sustainable value. So in some way, actually, they are not considered too much about the financial return. But ESG investing is to still, you need to consider about the financial return also. So that's the why that you need to think about this trade-off. So there is some difference between the ESG investing and impact investing. And then how ESG investment returns are growing as market evolves. So you may heard a lot of the like a news media cover that why you need to invest in ESG, because they will give you financial return, right? So here is one example that the ESG investment around the world between 1970 to 2014 discovered half of the investment beats the market. Only 11% perform poorly. So it shows somewhat that why that there is advantage of investing in the ESG. And also like a BlackRock that they also experienced that the more than 8 out of 10 sustainable investment fund of outperform non-ESG based like share portfolios. So in the private sector, so there is a particularly this asset management company show that the value of the investing in the ESG and sustainability. And then also here is that, for example, the financial institution estimated the ESG asset would be reach US $30 trillion by the year 2030. So this is a huge amount will be increasing. So they think about investors thinking about that this is valuable, and then it will be contributed not only for the society people, but for the financial returns. So this is one thing, but reality is that I have a look at this one. You know, like the funny thing that I will share is that the reason that the first time I ever actually looking at this was that someone actually that he was a CEO in some asset management company in Wall Street, and then we did a research together in a different topic in the digital economy or something like that, and then we are looking for the like a next topic, and then he had experienced ESG, and then he recommended me that why don't you looking at the ESG. And then he know that I'm a technologist. I'm applying like AI to the like for example like algorithmic trading. I can generate some algorithm trading like AI like program and things like that. He knew my expertise, so he recommended whether you can, if you can find out some framework whether there can be like a financial alpha in ESG. And then if you can make like algorithmic trading way to like developing the like fund management and investment tools for this AI, that will be in a good shape. But so that's why actually the was first time I looking at the wow. So looking at this one and then looking at the what is the issue in the financial area. And then so still there is a debate actually that really truly there is a financial alpha in the ESG like investing or not, but the recent trend that there may be, but in the case by case. So this will be the another topic maybe we should look at. And this is one I listen. This is a portfolio side actually. I mentioned that the balancing is the trade, not just the trade-off. We can find some way to balancing. Balancing means that if the trade-off means that there is no ways to you can move. This is one thing you see that here is a two-dimensional. Is one of trade-off means that you have a, for example, this is a financial return, and this is a sustainable value. And then trade-off means that there is some curve around that you can only move. And then the trade-off means that either go more in the sustainable value or go further to the financial value. So this is a trade-off. So depending on your policy and your decision making, whether you go this way or that way, right? Trade-off. But I just propose that not just a trade-off, you can be balancing. Balancing means that some way to you can change the situation, and then you can choose like a more in the sustainable value, and also like for example the economic return. So the way actually in the theoretically easy, because if you can expand this curve to the more bigger value, right? And then the issue is how, right? So that's one actually I researched it intensively for this one, and then actually I found some way, and then actually I did several webinar about the expertise of this one, but the issue is the same thing, right? Because in a portfolio company level and also investors, that if you think about like carefully and deeply, and then share with the insight with you like with the expertise, and then you can think about not just for the trade-off, but there may be some way to balancing, and then you can be more happy, like ending like for example more like a value to generate in the financial return and then sustainability. So this is one I want to share with you. Okay, so this one actually I summarize everything that maybe have you for understanding about what is sustainability strategy and then something like that. Okay, so I'm stop sharing. Okay, so I think that I cover enough time to fear the missing speaker today. Unfortunately, it's because this is not the usual way I cover, because I usually set up the like in 10 minutes. But today is an emergency situation also for me, so I cover as many aspects of the possible. Okay, so now let's hear from our distinguished speakers about their insight of the like sustainable finance. Okay, so we'll start from Joyce, and then later is Esperanto.
Sorry, Alex, there was a change in the middle. Ernesto goes first.
Oh, okay. Okay, you can go ahead. So. Yeah.
Sorry, Joyce. Thank you, Alex.
Yeah, we have two like no problem. Yeah.
Okay. Thank you very much. Thank you very much for the introduction, a good introduction, excellent introduction, Alex, to the sustainable finance topics. Laura, thank you for the invite, and I'm happy to collaborate with your interested initiative, TiiQu. I invite all the attendants to join TiiQu. And Alex, thank you for your great work in preparing this session. Always difficult, hard. Sure, it is a fairly broad topic, sustainable finance, and so I am going to focus on one of them. First of all, I start by saying that for me, something is missing in the different definition that we have so far about sustainable finance, because most of the definitions are looking at the use of resources, at investment, which is fine, completely fine, and I fully agree with that. But before that, we need the money to invest. So we need to create the instrument, the financial instrument, in a way that we can attract investor to really use that money in green, for example, or social projects. So I would like to start with 5 minutes talking about less maybe about me. I am currently a professor and researcher working at the University of Talca, associate editor of journals such as the Journal of Cleaner Production, Journal of Intelligent Manufacturing, and a visiting professor at the London Business School. And I was also recently professor at Fundação Getúlio Vargas, based in Brazil. Also, I am an editor-in-chief of the journal Sustainable Operations and Computer, and I am recently linked as an associate to the Center for Business and Public Sector Ethics based in Cambridge, UK. So my main passion is to contribute to solving the urgent problems posed by sustainability and climate change at the local, national, and global level. So that's because I am quite interested in to participate in this initiative and in this event in particular. So for doing that, I specialize in combining business model with a quantitative model, artificial intelligence, blockchain, and other tools to propose solutions to problems in several areas, including supply chain, energy, mining, transportation, agroforestry, among others. So I am going to talk maybe at the end a little about that. So that's why I am here to talk about one more alternative to help solve problems in this exciting area of climate change and sustainability. That is the topic of sustainable finance. And I think it is interesting to comment on the global context, like you put early, Alex, regarding some financial instrument that exist for project initiatives that promote sustainable development. That's the framework. In particular, differentiate that there are green bonds, social bonds, and sustainable bonds, in addition to green credits, among many other instruments that you can use to fund sustainable projects, sustainable initiatives. If we only talk about the green bonds, that is the funds raised through the sale of these bonds, allow financing of project initiative action that aim to have a positive impact on the environment, we see that they have had an explosive growth throughout the last year. It's expected that the green bond investment, just a green bond investment in a single year, could reach $1 trillion for the first time by the end of this 2022. So, for example, according to data from the Green Bond Initiative and the Climate Bond Institute, if the total green bond issuance in 2017 was around $160 billion, by 2021, these bonds were more than $400 billion, so more than twice. In the same period, that's another good information to keep in mind. In the same period, I mean 2017, 2021, the number of issuers went from 2,008,000 to more than 4,000 issuers. So green bonds are issued by governments, backed by the government, the central government, non-financial corporation, financial corporation, local government, and development banks. For example, the World Bank or the Asian Development Banks. Of the total of these bonds issued, financial and non-financial corporations are the main issuers. So we have private companies there, and they have more than 50% of the total green bond issued in the period. So the money raised by this bond, that is another important point, has been used to finance renewable energy projects, reforestation, transportation, land use, among any others. Many others. Projects in the energy, transport, and building sector are the main destination, with more than 70% of the total collected funds from the sales of these green bonds. So that's the main sector. I could say that the main concern, that is an important issue, the main concern that private and institutional investors, for example, insurance companies who buy this green bond have today is really to ensure, to guarantee that the use of these funds will be in projects, will be used in projects with a positive environmental impact, because I am talking just about green bonds. If we go to social bonds, we need to talk about social impact. The task force for financial disclosure, there's an organization, provides a guidance to all market participants on the disclosure of information of the financial implication of climate-related risk and opportunities, so that they can be integrated into business and investment decisions. There are also rules for the issue of these bonds, the green bonds, that can be issued by central banks. In the case of Chile, it was the government, the Central Bank of Chile, and almost the same in the case of Brazil. But you can also consider in this local government, like municipal. In the case of United States, we can see that. They can also be used by multilateral organizations, such as the World Bank, as I said. One point that is mentioned in the procedure is that the issue of the green bonds, normally you need to prepare a framework of the bond. That is, before to issue the green bond, you need to prepare a framework of the bond that is prepared normally by the government and supported by external advisor. There is also a certification. There is an organization that also needs to certify that the green bonds are really green bonds. So they look at the framework of the bond, and they look at the procedures that are stated there, and they certify. For example, one of the organizations is related to the Climate Bond Institute. So the procedure that go from the issuance to the monitoring and control of the use of fund will have a green destination. But even on that, you have also a post-issuance. I mean, post-issue is the bond you put in the market, some investor buy the bond. That's the post-issue. The post-issue, there are also a certification procedure, such as an audit, which guarantee the use of fund. But even you have all these procedures, the main concern on the investor is the investor. I mean, institutional investor, private investor that buy the bond is regarding the use of the bond. One of the states in the management of a green bond, and after they are issued, that is when the funds from the sale of the bond are available. So the organization inside, for example, government, receive the money. The issuer must have, in this case, the issuer must have a selection and monitoring process for the project initiative that they are going to fund with this money. This is where another important aspect comes in place, where there is a lack of installed capacity in the government and the companies that issue the bonds. For example, to generate, select, and monitor that the funds are well used. It must be remembered that the investor, the one who buys the bond as part of the purchase contract, receive an interest for a certain period of time, and then the liquidation of the bond. There are bond investors keep by 10, 15, 20, and more years before liquidate. So therefore, there is not only in the interest of the investor, the one that is buying the green bond, to guarantee that the funds are being used well, but also the issuer. Why that? For example, the government, otherwise, the loss of credibility of the government that is issued the green bond will make it more difficult for the issuer to obtain investor. And another issue is that it will have to pay more. I mean, the government, the issuer, will pay more interest to the investor, and will be less profitable for the issuer. So the matter of trust is also one of the main impact that you can get at the time of issuing the bond. This is also because a classification of countries, such as the one that the Moody does, is important at the same time of issuing green bonds, as well as for the investor to know the issue. Let me talk about the confidence of investor that the funds raised are actually used. That is inside the framework to issue the bond is called the use of proceeds in green bonds, in green projects initiative. Is one of the main concerns, as I said. So one of the research areas that now we are working is how blockchain can be used for this purpose, since this technology, blockchain, per se offers a warranty, ensure that the information contained in the blockchain is reliable and has not been manipulated. So that could be a good base to start again to provide trust to the investor, and also facilitate a lot of procedure that the government, the issuer, or the private company need to do. Right? In the case of Chile, the green portfolio included a project previously certified in 2019 and 2020, and resources not used in previous year, because we are talking about 2021 and 2022 now, resources that not used in previous year for almost $2 and $4 thousand million that are representing about 30% of the total issue in green bond. That means that if we put in the market green bond for more than $8 billion, we use it just 70%. 30% we don't use it. So the budget now, for example, for Chile, 2022 now, is the one that we didn't use, 2 and 4 billion, plus a new certified portfolio of for almost 400 million. So today there are available about $2 and $8 billion to fund green projects. Among the main buyers of this green bond are institutions USA, China, France, and Italy. Coincidentally, they are also the main issuers of green bonds worldwide. So same as in the original plan of Chile was considered to invest in clean transportation, renewable energy, land use, natural resources, and water management projects, really investment in clean transportation, mainly buses and a bike path, and green building, total almost 95% of the investment. So we didn't invest in, for example, water management projects. We didn't invest really in renewable energy projects. We didn't invest in land use and in natural resource projects, even when we didn't put almost 2 and 4 billion of dollars. So the question is why? I don't have the answer now. I don't have why that happens. We are still studying, analyzing what happens. One of the consequences could be pandemics, because at the same time that Chile issued green bonds, we also issue social bonds. And social bonds take a lot of attention during pandemic, because social bonds were used, for example, to give money to companies, to keep people working. We also give money to family that need money because they didn't have people to work during pandemic, so they need money to buy essential thing to live. We did money to review houses and so on. So maybe the attention that the government put was so much, the focus was so much in the social bonds and not in the green bonds. That is because we didn't invest $2.4 billion. So we are exploring now how to finance an initiative in the agroforestry sector. And with this, I am going to finish. In the agroforestry sector, that includes investment in roads, circular economy, and energy as the main focus for the use, for example, of biomass generated in the operation of the agroforestry sector. So the typical procedure that we are following now to see the feasibility of issuing green bonds to find this initiative is the one that recommended, for example, by Climate Bond Initiative. We start with the definition of the use of proceed, that is identify the potential project that could be eligible for this green bond. Then we need a procedure for selection of the projects, and not only selection, we need also to evaluate the project from a sustainable and in particular green perspective. So what is the impact of this project from the perspective of the environment? So it's positive, it's negative, or how we do that? And that's because I thought that we need to create an expertise, knowledge in the people that is related to this initiative inside the government, because they need expertise to analyze green projects and really get the decision if they are eligible for funding through green bonds. The other is the traceability management of proceeds. That is the point that I am talking a lot about, because it's a really an important issue. Is how you ensure that the money is really going to fund a green project. So you need the traceability. And that is because we think that the blockchain could be a good tool to help in this. Then we need to publish reporting that normally people talk transparency reporting. To uphold credibility, it's essential to be transparent toward the market, in particular to the investor. And that again, the same topic, that is the trust. Trust that the money is going to be used well in green project initiative and so on. And then we need the external review, that is the verification and the assurance that the funds are using well. So that are the typical procedure to issue a green bond and to also manage the green bond, because as I said, you have sustainable finance that is taking into account the impact of ESG. Okay, but you need the money first. And one of the instruments to have the money, to bring the money for this kind of initiative, to find a green project, is to issue a green bonds. If you go to social bonds, you have almost the same. I mean, the same issue and the same worry of the investor, that the project that are funded with the money that is put in the investor is used really in social impact initiative. So there are, for example, to classify, I am going to finish now, to classify if a project is eligible. I mean, it's a green project or not. You have many organizations that are publishing what they call a taxonomy. First, you have a minimum of two. For example, the climate bond taxonomy that we take into account, for example, in some countries, but there are also the European taxonomy, and there are also the green taxonomy, and so on. And you need to know very well that, because that describes the characteristic that a green project has to be eligible, to be funded by money that come from the sale of green bonds. So, and I would like to stop here. I spent more than 10, maybe 15 minutes now.
Thanks, Ernesto. Yeah, it was a great sharing of your experience, expertise, and insight about the green bond. Yeah, it's like because a U.S. professor is a different level like understanding to deliver like a lecture type. It was yeah, fantastic. Or the next point, we are the practitioner of this sustainable financing. So Joyce, could you share your insight?
Sure, and thank you, Alex and Laura and Ernesto. My name's Joyce Johnson Miller. I am now serving on several corporate boards, both private equity owned companies as well as public companies. My background has been over 35 years in investing, and both in private equity and private debt capital. I also am a chairman of the board and chief investment officer of Pacific Gate Capital, based in Los Angeles, California, and Seoul, South Korea. Go, Alex. And we take capital there from Asia and invest in US debt companies. ESG and sustainable finance has been a huge part of our track record going forward will continue to be an increased element. However, I'm going to take a little devil's advocate and lighten up the panel, since we've been chatting for almost an hour and want to allow time for questions. But there's a certain gentleman who today's one of his companies was removed off the ESG index. So we can all do a little Bloomberg snooping and homework. And he stated that, ESG, I think his exact quote, and he also likes to tweet a lot, so you can probably figure out who this is. He stated in April of this year that he's increasingly convinced that corporate ESG is the devil incarnate. Corporate ESG is the devil incarnate. He further went on to say that investors who park their money with ESG funds that are managed by large asset managers are unaware that their capital's being used to buy shares of company that are really not affecting climate change and really actually doing some harmful things. He further stated that we needed to create a system that measures and scrutinizes active positive impact on the planet so folks that can actually see and prioritize change. Very interesting comments made less than, just a little over a month ago in April. And then lo and behold, today, Tesla was removed from the ESG index. I do believe, however, though, that some of Mr. Musk's comments go to Alex's earlier comments about seeking balance and having an approach that makes sense that can be monitored. So my remarks are going to focus on some of the elements that we see in our public and private companies, some of the issues that are affecting our markets, and then how can sustainable finance continue to move forward. As Alex and Ernesto mentioned, the sustainable debt market has reached a record high and peak and has continued to poise for growth in 2022. The key challenges will be a few key challenges. We'll really try to combat some of the issues of greenwashing, which both Mr. Musk is purporting, as well as some of the elements that you purported, Alex, in your comments. While many companies have set a lot of high sustainability goals and ESG data, investors and regulators are increasing scrutiny on these corporate sustainability efforts. And I'll speak about that a little bit more. From a board's perspective, this year, a lot of boards will face a lot of rising pressure to demonstrate that they're equipped to understand and oversee ESG issues, whether it's from climate change to social unrest to human rights. This has been a very big effort for both public and private corporate boards, as there just has not been a lot of training. It goes to Alex's earlier point of the wide breadth of issues that ESG and finance is covering, and boards have not been equipped to really deal with many of these issues. Following some unprecedented focuses in board momentum and growth in ESG in 2021, there's been a really increased area for climate pledges in 22. As Dr. Ernesto mentioned, from biodiversity to environmental concerns, we're really in the spotlight for ESG, but there'll be rising demand for greater accountability. And there's many corporate views, I think, that have come up with regards to what the intersection is of accountability. I think folks have always found a credible, sustainable debt market, as you mentioned, Ernesto, around green bonds. I'm troubled by social bonds, as I cannot understand them sometimes. They're sometimes lacking in the key distinctions that net zero actions that you can find from finding capital or climate stress tests. Those are identifiable KPIs or objectives that investors can benchmark to. I think folks are finding it difficult to really find some direct influences on many of the social bonds that were raised. That doesn't mean that they can continue to raise them. I think they will be better understood. But I think this year and the next coming years that there needs to be a more defined discussion around what the accountability measures and regulatory scrutiny will be for those types of bonds. The second point I'd like to raise is there's been increasing pressure for voting against directors for lack of credible climate action plans. This trend has really been a big trend in 2020 and 21. I think there will be an increased trend in 2022. In 2020, there were 4 times as many negative ratings for board actions and shareholder activism around climate change campaigns as opposed to 2019. And that 70% of all these actions were related to a lot of mergers and acquisitions. So now that those mergers and acquisitions have settled, there's been a lot of environmental and social campaigns to really help guide and push the actual actions of companies to really adhere to all of the comments that they made about why these 2 companies should have merged and were expected to generate some great ESG initiatives. Third point is regarding global scrutiny for demands and corporate reporting. This will be a big driver for sustainable finance fundraising. We have another new group that I think just formed, International Sustainability Standards Board. That's a mouthful. I think it's called ISSB. But that board is really focusing on accountability, how to have a common baseline for disclosing standards across global jurisdictions, which I think is which, going back to Ernesto's comments, if we have baselines that are common disclosure lines, this will make measuring the accountability for a green bond and for a sustainability bond much more easily to track, but also then easier to raise. So these are, I think, very, very focused initiatives. But it will be tricky for the ISSB, which I think was formed in January of this year, to set global frameworks, because every company, country, city is different. But I think we're in a data gathering metric standpoint that although this is a rapidly growing industry, the data is starting to come together. And one example of a company that I've been following that I think is really data driven is a company like Salesforce. Many people have used Salesforce or are familiar with it. Over 27 billion in revenue. You would say, how does a software CRM system drive its ESG initiatives to also then drive impact that can be measured? And I'm using Mr. Musk's comments. That's something that's really making sense. And Salesforce is one of few companies in the world of that size, 27 billion in revenue, that has achieved a net zero carbon emission across its 100% value chain. And that is a big, big metric. 27 billion in revenue. Their spend is, their costs are close to 7 to 10 billion. And that means they're buying goods and services from other players, other suppliers. To achieve a net carbon zero emission across 7 or 8 billion of capital is a huge task. In addition, they're 100% renewable energy for all of its operations globally. That is a very big task, considering its size, but also the ability to go back and have to retrofit facilities. But those are measurable tasks that one can say that you can check the box and definitely say that we're achieving emissions. Thus, they should be able to go out and raise, if they need to, value-based bonds and green bonds, because they can easily prove that they're 100% renewable. I will also close here quickly. Let me just go back to my comments. I think government, let's chat about governments. We chatted about ISSB, which is going to focus heavily on global companies. Governments will face similar challenges to turn these net zero pledges into near-term actions. The interpanel government from the UN on climate change that really is pushing for a net zero emissions globally by 2050. Really needs some data because currently the data in it's code red, as they said in 2021. They will release some new reports on how to recalibrate. So we're seeing data. It's not showing that it's going to achieve a net climate change of net zero by 2050. So there needs to be a recalibration. And so governments, in both aligning with their countrymen, but also aligning with their corporations within their countries, will have to recalibrate to see how they can provide some credible, achievable near-term goals to the path to decarbonization. And then the last comment I'll say is climate transition strategies will also become social issues. Folks are challenged to take the E and the S and put them all together. But how we can have credible services and actions in our social communities, particularly underserved communities, that will help drive climate change. They're really seeing this come out in many emerging economies, underdeveloped economies, and it's an important point that I don't think was as focused at the onset of ESG, but has become a very big issue in 2022. Finally, I'll end with the social supply chain. This is, I think, one of the fastest areas, particularly what we see what's going on with human rights and labor conditions. I think this will continue to persist in the economy. The pandemic, as we start to recover from it, has probably heightened this issue more and more. But I think this issue will heat up as well. Last point goes to how we have a $1 trillion sustainable debt market, and where will it go? It increased 61% from 2020 to 22. Historical trends say that 2022 is going to be a very strong year. However, in a rising rate, hawkish type environment, I question how many times folks will pivot from their ESG initiatives to manage their businesses if we're hearing recessionary themes throughout the marketplace. Again, I think it's an important element from an ESG standpoint to continue to focus. But CEOs, currently believe 80% of CEOs surveyed believe ESG is a top priority. But we've had some glorious years of performance in the marketplace outside the pandemic. I hope that they will stick to their proponents of their ESG themes and engagements as we potentially may go into a recessionary environment. As, priorities do change in tough, tighter market conditions, and there's continue to be some fragmentation in the marketplace. I'm going to pause my comments now and thank you all for allowing me to share my insights. But I do not believe, like Elon Musk, that ESG is the devil incarnate. I do believe that the necessity for balance, as Alex mentioned, and clearer priorities and areas of measurement will be the key to how we grow and continue to have a exponentially growing sustainable bond and debt market. Thank you.
Thank you, Joyce. Great insight. I think that I'm very grateful that you mentioned several things have a same mind as me. For example, that you mentioned about for measurement, that's a very important issue. For example, that we have a missing is that for example, a lot of there is the measurement standard, usually you've mentioned about is read by the accounting, like companies or association like a ISSB, or you mentioned about several others. They concern about accounting, like a responsible accounting or something like that. But we also should think about for example, nature of the ESG sustainability management, right? Because we for example, this is one example that typically we think about in the social factors or some governance factors that we think about, for example, the diversity and inclusion in your board member. And then usually the suggested metrics is how for example, the woman, the board members included in your your board members. But usually the metrics is a number of the women board members. But usually that's not what you want. Actually, how they involve, how they participate in the decision making process, and then how the outcomes actually the positive impact to this board decision to your ESG, right? But but we are lack that kind of the measurement, because there is a difference between actually what you measure and actually what you propose, right? So that's one big gap, and then that's why I mentioned this demon, because we are actually measuring wrong thing, right? But also we need to also think about for example the uh, the return of this social value will be not directly contribute to your like a financial returns. So how actually you can, for you need to be patient about your the investment. And particularly I'm very interesting, I also have a short-term experience in private equity. And then I try to raise a fund, and then you need to raise a fund. You're the expert, so you need to have a specific goals, and then you make some like what you propose, and then you propose your like limited partners of what you're doing there. But in the private sectors, we are very familiar with, like, for example, the notorious but the easiest way to leverage buyout style, like you get the company and then reshape it and then resell out in a quick return or something like that. But whether that kind of like a traditional way to like get the return will be good for like whether we fit into like a philosophy of the private equity like a fund management, right? Is in the ESG will be the I'm very curious about like the role of the private equity fund for this kind of ESG investment and financial. And then also you also raise many different like key issues actually that we need to discuss further in the panel discussion, because we have a lot of time now. So I think that
we finally have no time. Well, anyway, there are 10 minutes. In 10 minutes, a couple of questions we can dig into a couple of topics, right?
Mm-hmm. Yep.
Or at least ask to Ernesto.
I think that we can have from the audience. So we want active participation, and then you can have your question, and then you can tell.
Don't be shy.
Yeah, is there anyone? It's a great opportunity to disclose yourself, and then whether you can have a question or you have a comment or the insight, you can share it. I have a familiar name that I know that he is really have a great expertise. Peter.
Peter, yeah, of course.
Yeah. He is a really have expertise in sustainability in the financing area. So.
Yeah, so sorry everybody.
I found your name.
Yeah, that's okay, Alex. I'm trying to be quiet because I'm not actually I'm not in my desk, so it's a bit difficult where I am. I'm actually on a visit somewhere, but I wanted to dial in. Thank you for your contributions. I guess, Joyce, I've just tried to look on my cell on my mobile about Tesla, and I really am not surprised. It's a fascinating juxtaposition of financial performance, which is meteoric in terms of share price, versus ESG concerns, and they're quite many. And S&P, coming off the S&P 500. Is really quite, reputationally, if I was running a business, I'd be really concerned. And I'm just wondering how that's going to play out eventually in the consumer space or the customer space with vehicles. When people go and, put a steering wheel in front of them, they actually trust the brand and they assume that the brand is going to look after them. And, the most fundamental thing I guess Tesla's got to look after is the safety of the automated sort of option on some of their vehicles. But for me, I'm more concerned upstream in their supply chains with the raw materials they have, because I know there are some real major, modern slavery concerns. And I find that on a personal and a professional sort of ESG basis, really quite concerning. So it's an example of how, ESG has got different definitions and understandings, and Alex, you described it in the financial sense. I come from private equity. I went from supermarkets to private equity like yourself, Joyce, and my whole time during private equity, 12, 15 years, I took a long time to train the boards of directors and to really understand materiality risks and disclosures. But I had a fantastic, boards that really embraced everything I sort of designed for them, and really didn't have a problem eventually. But Tesla's a really prime example of how ESG, if you do it properly and you interrogate, performance and materiality risks and disclosures, it works. That's my experience.
Thank you. I think that we have one, maybe Shadlek. I think that he shared a lot of questions. So why don't you speak to have your question or the comment? Yeah, you are the winner of today, anyway.
Thank you kindly. Thank you so much, Alex. Great takeaways. I've actually got about 4 pages of notes here.
Oh,
great.
Professor Anderson maybe gave you can give you the A+.
You're so kind. Thank you. One of the common themes that were brought up, Joyce even touched on it, the social supply chain. It's interesting how there tends to be a bit of tension or juxtaposition between pledges and action. And she also mentioned the 2050 slightly moving target. And I did a quick maths and I realized that those 2020 zero emission commitments, they are only 1,441 Saturdays away. I repeat, that's 1,441 Saturdays, because when we say 2050, it feels like an eternity of days. Similar thing with the SDGs. Whereby some people think that the fulfillment or the milestone for cutoff for fulfillment of SDGs is only in 2030, but that's only 398 Saturdays away. So I think these are wake-up calls in terms of a bit more transparency and a bias towards action by the various bodies, institutions, and regulators tapping more into blockchain in order to cut across silos. So great takeaways once again by the 3 speakers. Much appreciated for your expert input, leading from the front lines. Thank you.
Thank you. Okay. Lavi, are you there? So the Lavi's question is one of the many issues with ESG finance is that government policies and regulation are not aligned with the corporate adoption and also the lack of the agreement on and availability of the actionable ESG data. Yes, that's true. Yeah. For example, that recently that everybody know about the final U.S. government SEC. They passed a rule that some of the mandatory disclosure of the climate change risk management, right, is the one thing that I think that the governments also try to do to interrupt some way to improve the situation. And then as far as I know that in the South Korea, that the South Korea government actually issued the rule that by year 2025, every big companies have the mandatory disclosure rules. So each country, the government actually now try to have the effort to contribute in some way. But you know that I previously I was a government officer in South Korea, so it's very difficult to have the public policy to starting to actually to include it and the acting law is a rule. The passing the parliament and then announcement, and then there was some period of the practicing and then finally a lot of things. And then also the difference between the private sector is that because they really concerned about the public interest, and the public interest means that the unanimous, right? They want to be harmonious around the stakeholders. So that's why that it's very, very, very timely and difficult. But that's why that, for example, in the United States, we have a 50 like a state. They have an individual like a rule, and then completely independent. You maybe know that before in the Trump and the Biden like administration of the COVID-19 administration, and the government, the central government say, and the state governments no, something like this. So we have a lot of degree of freedom. So it may be the difficult situation to have a unanimous rule in the central way, but that's why the European countries more like homogeneous, and they have more consensus about it. Why they are reading this area. Also South Korea and other China also have a government read. So that's why, but the situation will be changes. And then for the data, data is not just for the like, yeah, you know, like the problem with data, everybody know about the problem with the data and then how they fix it. But the difficulty is that is, for example, that I'm a very expert.
Alex, sorry, can I interrupt you just one second? Because we have somebody who needs to go for a lecture, who is Dr. Ernesto. Can we just ask him to close his part, and so he is free to go, and then we continue? Ernesto, can I ask you to give your last thought for this session, and then we go on with Alex. Sorry, Alex.
Oh, that's okay.
Okay, so sorry, Ali, and thank you, Laura. No, just to say thank you to Joyce and all the attendants. I think that this topic is really very interesting, sustainable finance. And as I said, there are a lot to do in this area. From the side of the government, corporate organization, non-financial corporate organization, and from the side of the investor are people interested in to move forward sustainable development. So I think that we need to also understand what are the needs from the side of the governments and the companies that need the funds to finance their green projects or sustainable projects, but we also need to understand what are expecting the investor, and to do that there are a lot of research that we need to do, but a lot of real practice action that we can also engage on them. Okay, so thank you very much, Laura, again, and Alex.
Thank you, Ernesto.
Thank
opportunity.
You.
Bye bye.
You.
Bye. Bye.
Because I will keep continuing about the data. Actually, that's a big issue. So we cannot tell too much, but that's when everybody have a concern about it. And also, like data means that some technology should be involved, and then some the changing. So for example, digital transformation, not just for like technology, they means that the culture changing and the philosophy change and business practice changes. So in the ESG practice or some way to relate to data, actually we need to slowly changing, not just for the like implementing digital technologies to get the data, but also like how you actually dealing the data, and then how you why the consensus about the member of the community that the importance data and how they utilize it. So we need also changing the like in the mind change and the cultural change and everything. So that's why it's difficult. Everybody understand why we need it, and then there is a progress is going on. Yeah.
So I think it's time to close, to wrap up, Alex. Shall we ask Joyce?
Maybe we maybe because we have an equal opportunity, right? So I want to hear from Joyce about the final comment of the insight, and then why don't you level?
Well, thank you all. It's a pleasure speaking with you. I think this is a very great topic, and hopefully we can continue having these dialogues and monitor the success. I like Shadrach's how many Saturdays until 2050 comment. I thought that was very interesting. But I also think that we're going to see a lot of development in 2022 and 23. This industry is still at its very early infancy, and we'll be curious to see how the corporate raising of sustainable bonds will continue in a rising rate environment and hawkish environment. But thank you all for allowing me to participate. I really enjoyed it.
Thank you. Yeah, Laura.
Thank you.
What is the level?
Well, I can only make one comment. We need to do more for sharing knowledge and facilitate everyone to access this information. I think we have a primary responsibility and let others understand all the shades of these important topics. So I invite you all to participate in the Wikipedia of questions and facilitate everyone to access knowledge on a shared base. So thank you very much for Joyce and Alex for your great insights, and to everyone for participating.